Okay, so we're going to start learning about some information about cash and internal control. It's a little different from what we've been learning, but it's still the same basics that we're trying to understand about the business. But we'll study more about this in an upper level accounting class later about internal control, and then cash controls, which includes just basically the bank reconciliation for purposes of this chapter. We will delve into a little bit to make sure that you're comfortable with what to do about cash so you don't embarrass yourself when you get into the real world. Okay, so first we'll talk about the internal control though. There's a lot of room for there to be misrepresentation in accounting. And so over the years, a lot of trial and error has arisen about ways to keep the assets safe and to make sure everything is reported properly. And so ultimately, because of that process of trying to find a way to make everything accurate and secure, and because of some indiscretions from accountants and managers in the past, the Congress decided to implement a rule about what accountants should do, and it was called the Sarbanes-Oxley Act. And basically, it's just a mandate that accountants must be stricter about their control factors, making sure the company has in place some policies that can take care of these objectives of internal control, like safeguarding assets, providing accurate information, and complying with the laws and regulations that are in place. And so in order to accomplish those objectives, there's these elements of internal control that we'll talk about. And that is the control environment, the risk assessment, and the control activities, which is specific activities that can be done to mitigate risk, and then information and communication about those internal control policies, and then monitoring of them. And so under the control activities, there are 6 specific things that can be done to make the assets more secure to accomplish these purposes, to provide better information and to comply with the laws and regulations. So those would include establishing responsibilities where it's clear who's going to take care of this problem, and where the buck's going to stop, basically, who's going to be accountable if something goes wrong. And then segregating duties means, as much as possible, separate duties that allow risk. So for instance, if you have cash, you want to keep the person that's recording the cash separate from the person that is collecting the cash, if at all possible. So in little small businesses, sometimes there's only one administrative person, so they don't have the ability to do segregation of duties. But in a large business, a lot of times it's a little more trouble to separate duties or segregate duties, but it can be done. So one person collecting cash, another person recording that collection, and also one person billing the customer and another person collecting the cash for the payments. And so that can stop a lot of trouble. And then that's just on the cash side. There's also a lot on the order processing and delivery of goods and things like that can be put into place to try to mitigate the risk. And then there's restricting access, which would be finding ways to make sure that only the people authorized to access the assets can do it. And also the people authorized to access the records should be restricted. And then documenting procedures so that it's clear what has happened and that you have a paper trail to show where you are with this asset. And then independent verification is where another person that's not involved in the process, it comes in and verifies that these numbers are accurate. So in the case of cash, again, that would be just a bank reconciliation. So these things, we won't dig deep into this because I say we do this in upper level accounting classes, but it's just, I want you to be familiar to some extent to have thought about these things, because even if you aren't an accountant, you need to understand that there needs to be these policies in place in your company so that you can be more secure and make sure that you are providing good information and protecting your assets and abiding by the laws and regulations. Okay, so we'll do some exercises about that from our textbook, and also the Learn Smarts give you some exposure to those as well. Then for cash controls, the bank reconciliation is really the only cash control that we're going to talk about here. There's also cash controls involving petty cash that we're not going to spend a lot of time on, but they are important also. But the bank reconciliation is the one we're going to focus on for the moment. And basically, there's two parts to the bank reconciliation, the book side and the bank side. So the first part we'll talk about is the bank side. What happens is the bank sends you a statement at the end of the month. And when they do, or at the end of the period, it might not be actually at the last day of the month, but the end of your reporting period with the bank, they send you a statement and it shows all the transactions that happened this period. But there are some things the bank doesn't know about that have happened in your company. So like if you've written checks in your from your bank account, not all of them have probably cleared the bank. So the bank's only aware of what happened there, what cleared. So you'll have some outstanding checks that still have not cleared the bank that you'll have to take the bank balance and adjust for those outstanding checks. And then by the same token, there might be some deposits that you have recorded, but that haven't actually cleared the bank as of the day of the statement. So you'll have to add those back to the bank's balance in order to come to what the actual correct balance is. And so I'm calling that the adjusted balance. I think the textbook calls it something like the up-to-date balance. Some people call it the corrected balance. But in any case, you want to adjust to the actual corrected balance on the bank side and on the book side. So for the bank side, usually that just means adding deposits in transit and subtracting outstanding checks from what the bank statement says. That will bring you to the correct balance if everything cleared. And then there's also the possibility the bank could have had an error in their bank statement. And I have had this happen at times. Sometimes there's a deposit error and sometimes there's a check error. So one time I had a client that paid me a payment for my services for the month, and it was $3,000 something, and the bank actually coded it for $30,000. And so on my bank account, on my bank transactions, it showed a deposit for $30-something thousand, whereas the deposit I made was only for $3,000 something. And on the client's records, their checks showed a $30,000 check, 30,000 plus, instead of a 3,000 plus check. So as you can imagine, that made my client a little crazy, and he called me up and was having a hard time communicating what the problem was because he was so distraught. So we got that straight. I called the bank. They called my client and said, hey, this was nothing to do with her. We made a key error. And so they got it straightened out. But if people weren't reconciling their bank statement, because my client had a large balance in his account, it didn't throw him to an overdraft. Now, if it had happened in reverse, there could have been a problem with my account. But in any case, my account was taking a big deposit that I had not expected. But if neither of us had reconciled our bank statement, how would we have caught that? So when you reconcile your bank statement, you see things that are recorded on the bank statement that are not in your books, and you go, oh, okay, I guess I need to record this. But when I found a $30,000 deposit instead of a $3,000 deposit, I knew there was an error. So immediately I knew I needed to deal with that. Of course, my client actually found it first and he notified me. So that was just good because he was watching his bank statement. He was watching his reconciliation, and he handled it the right way by saying, hey, what's the problem? I know this is not right. But in any case, the bank can have an error, but most of the time the bank does not have an error. Most of the time the bank balance that you see on your statement needs only two adjustments. And that is they need to add back deposits in transit and subtract outstanding checks. Now, then once you get that adjusted balance, then you go to the other side of the bank reconciliation, which is the book side. You look at what your T account or your general ledger shows as your ending balance for that period of time for cash, and you add back and subtract things that the bank knew about that your books have not recorded yet. So that would be things that the bank added, like interest that the bank added to your balance or service charges they subtracted. Sometimes it's a check that a client gave you that didn't go through and clear. In other words, it was a hot check. And so you have to redeposit it, or you have to go back to the client and ask for another payment form. Or it could be like there's occasion where the bank collects cash for individuals. I had some clients over the years that have had notes where they self-financed assets that they sold, and those notes, the clients would go straight to the bank and deposit those payments to the bank account for them, for the client. And so when they got their statement, they would adjust it for the deposits that the bank had made that they hadn't reported yet. But anyway, that's the deposit memo. And so errors also that the book made could be found and corrected here. If you transposed a number when you were posting a check, and then when it came through the bank, you saw it was a different amount, you would have to correct it whenever you're making your adjustments for the bank's, the book side of the reconciliation. So most of the time, most of the adjustments that need to be made are on the book side, because again, the bank seldom makes this kind of error, especially these days when they can scan the checks in. And so you adjust you need to make sure that the bank reconciled amount equals to the book reconciled amount. And then everything that you adjust on the book reconciliation side needs a journal entry. So every interest revenue that was earned, every service charge needs a journal entry. So we're going to work on some of those with some exercises. These exercises are coming from the Openstax exercises, the free textbook access. And I've got a link at the bottom of this note sheet, this lecture note sheet, to lead you to that. This one is coming, let me see what chapter it's coming from. So I can hang in there at the bottom. Chapter 8 of the Openstax books is where this one's coming from. Okay, so this one is EA9. They give this information. Use the following information and prepare a bank reconciliation. We have a bank balance, a book balance, deposits in transit, outstanding checks, interest income, and an NSF check, which is that check the bank deposited for our clients, gave us money and it didn't clear. In other words, it was a hot check or an insufficient funds check. So let's start with the bank side. So that's usually the easier side. The bank balance, the bank thinks that we have in our account $4,587, and we're going to add back any deposits in transit. We know how much they are because it's very easily spelled out. And then we're going to subtract the outstanding checks to come to a reconciled balance of, I'm calling an adjusted bank balance, $5,177. So now we're going to reconcile the book side and see if we come to the same number. Most of the time, the easiest thing to do is just to mark which one is going to, if they give you all this information, you can just mark which one. So this is bank. So when I'm doing reconciliations, usually I just mark which, when they give you the facts, mark which side of the reconciliation it's going to affect. So I go through and pull the bank balance and the deposit in transit and the outstanding checks, say that's going to go on the bank side. The rest of them are going to go on the book side. Okay, so on the book side, I start with my T account balance or my general ledger account balance for how much the balance per book is $5,577. And I add back things that the bank knew about that we had not recorded on our books yet. One of the things that got added is interest income or revenue, either way you want to think of it. And then the thing that got subtracted this time was this non-sufficient funds check, colloquially referred to as a hot check. So if my book balance is $5,577 before I started adjusting, and then I added the interest income and subtracted this NSF check, that means my adjusted balance per book is now $5,177. I look back at my adjusted book bank balance and it's the same number. So I'll like cheer for myself and congratulate myself. And so this is all good. We balanced, so we're happy. Now we realize that in order to finish this reconciliation process, I need a journal entry for everything I adjusted on the book side. Because if I don't change anything, this book balance of 5577 is going to remain on my books. If I wanted to agree with the balance that is in the that is actually reconciled for the after the bank statement 5177, I have to make the journal entries to record these two adjustments on the book side. So the journal entries are going to just take care of that. We're going to record that bank interest income with a debit to cash, credit to interest income. We're going to record that NSF check with a debit to accounts receivable and a credit to cash, because it's the customer's check was not good. So they haven't actually paid us what they tried to pay us originally. Now they still owe us. So that's accounts receivable. They will need to send them a note, call them up, or send another invoice to remind them that they still owe us the $456. Okay, that's that one. Now we'll go to EA11. Use this information to prepare the bank reconciliation. So if I were you, I would pause the video, just try to work this one out, and then come back and see if it's right. So, all right, so assuming you either did pause or you didn't, either way, we're just going to tackle this the same exact way that we just did the first one. I'm going to pull out the things that I think affect the bank. There's that affects the bank, and then the outstanding checks and the deposits in transit affect the bank. Now let's see, the book balance does not affect the bank, neither do the bank charges. Bank incorrectly charged the account $75. They're going to correct the error next month. Oh, a check was written in error. That's on the bank side. The bank incorrectly, we're going to put that on the bank side too. So what we got is the bank reconciliation side looks like this. The bank said we had $6,988. That's the ending balance on the bank statement. Then we're going to add back the deposit in transit of $1,600, and we're going to add back this error the bank made that they're going to correct, but right now they haven't yet. So it's going to be another $75 added to our account. And then we're going to deduct the outstanding check to come to the adjusted balance, or the up-to-date balance of $6,641. And then we're going to work on the book side and see if we can bring it to that agreement. So the book started out with a balance of $6,626 in our T account. Oh, come on, really? Or our general ledger. It just doesn't want to show it to me. And then we're going to add the things that the bank knew about that we didn't know. So let's see, does the bank have any add-ons they gave us this time? Let's see, the check number 2456 correctly cleared the bank in the amount of $234, but it posted the accounting records for $324. So we had an error in the books where we deducted too much. So we're going to add back that error correction, because we reduced our balance by $324 when it should have been $234. It's a $90 adjustment because we deducted too much for that utility bill. And then the bank service charges, $75. So if we take our $66.26 and add the $90 error, subtract the $75 charge, we come up with $6,641, which agrees with our bank side. So we pat ourselves on the back and say, yes, got it. So now we know the next step is we have to make a journal entry for this error in the check. And then we have to make a journal entry for the bank service charge. That's what we're doing now. For the, to correct the error on the check that was transposed, we have to look at what we posted that check to. In the description, it said we had posted it to utilities expense. So when we correct it and reduce it back down to $234, we're going to correct it by crediting the account that we over debited, so we can get that back to correct. And then we're going to just record the bank service charges as an expense. That could have said the word expense instead of charges, but it is an expense account. Okay. Now, PA 7. we're supposed to identify on this one where the following would be found on the reconciliation. And so that we're just trying to mark whether it's an increase to the bank side, a decrease to the bank side, an increase to the book side, or a decrease to the book side. Outstanding checks, those are decreased to the bank side, as you know. It just doesn't want to talk about this. They might not be there. I might have to put them in there. Okay. And then interest income is an increase to the book side. We make these centered so they will show up in the middle. NSF check is a decrease on the book side. Wire transfer by the customer, that's money that was deposited, but we didn't know about it until now. When we get the bank statement, deposit in transit is an increase on the bank side. Bank charges is a decrease on the book side. Sorry about these X's being different. Let's make them, we'll just make them all little since they're almost all little. Okay. Now, let's see here. Oh, I see what's wrong. Hey, I had the format in here, but I just didn't. I'll just check myself and see if I did anything crazy. This was the problem at the top, and then this solution just restated the problem. So yeah, let's see. The only one that adjusted an increase to the bank side was deposit in transit. The only one that decreased the bank side was outstanding checks. The increases to the book side were the interest income and the wire transfer. The decreases to the book side were the NSF check and the bank service charge. So yeah, that's right. Might as well get rid of this because we have it right here in the solution. Okay, let's see what we got. One more. This is PA8. Which of the following transactions will require a journal entry? Indicate if it will be a debit or a credit and to what account the entry will be recorded. So the transactions that affect the book side are the only ones that require a journal entry, right? So here now, I finally learned something. This is the problem set up here. So we're not going to mess with it. We're going to put our solution in the solution box. Outstanding checks do not need a journal entry, do they? Deposits in transit do not need a journal entry. All right, interest income. Does that need a journal entry? Yes. NSF check? Yes. A wire transfer need a journal entry? Yes, because that's something the bank knows that our books have not recorded yet. And the bank charges? Yes, that's something the bank has charged us, but they haven't notified us until we get the bank statement usually. And so the account that we're going to debit for whenever we see that journal entry is needed for interest income, we're going to debit cash, credit interest income. Now for the NSF check, we're going to credit cash. We're going to debit the receivable account because that customer is going to have to still give us that cash. We are going to bill them again. And then for the wire transfer, we're going to debit cash. We're going to credit that customer's accounts receivable, say paid a payment. If they were just buying something via wire transfer, we would credit the sales account there. But if they just are transferring a payment by an accounts receivable customer, we would credit accounts receivable. And then for the bank charges, we are going to credit cash. We're going to debit the bank charge or bank service charge fee. Bank fees, bank expense, bank service charge expense, lots of different names you can name it. Okay, and so again, these came from chapter 8 of the Openstax textbook. And that's all for this chapter lecture.